In investing, inflation and rate of return are two very important concepts. We're going to talk about both of those, including the types of return, nominal and real rate of return. First, we need to talk about savings accounts. Savings accounts are FDIC insured. FDIC stands for the Federal Deposit Insurance Corporation. So savings accounts are insured through a government program so that if a bank goes out of business, you don't lose your money. In previous units, we talked about how much your account is insured up to. Does anybody remember? The answer is $250,000 per account. So as long as you don't have more than that amount in an account, your money is safe. Now, the FDIC does not insure investments like stocks, bonds, or mutual funds. There's no guarantee you're going to get your money back. If a business goes bankrupt, you won't get a return on your investment. Inflation is an issue that investments face as well. They refer to it as the return killer. Does anybody know what inflation is? Inflation is a general rise in prices. So what does it do to the value of your money? It decreases the value of your money. $1 cannot buy as much as it used to be able to buy. So your nominal rate of return and your real rate of return are two ways to show how much money you're making on an investment. So nominal rate of return is the rate that is stated on an investment. If you're told an investment will earn 5% and there is an inflation of 3%, did your money really grow 5%? Is your money really worth 5% more? Can it buy 5% more of goods? If you look at your real rate of return, it shows you how much your money actually grew. You take the nominal rate or stated rate, in this example it's 5%, and then you subtract out inflation because inflation has decreased the value of your dollar. So you have 5% growth, but inflation or prices went up 3%. Your investment really grew by just 2%. You can only purchase 2% more of goods. A brokerage firm is a firm that manages investments. You would go talk to a broker, a stock broker, and they would be able to help you invest in not only stocks, but bonds, mutual funds, and other types of investments. They manage your account for you. Not everybody goes to a brokerage. Many people do their own investing online. You can go to an online stock trading site such as E-Trade, and you can buy and sell your own stocks. Typically there is a fee per trade, but a lot of times it's cheaper than going through a brokerage. However, a brokerage will help you out and give you advice on investing. Brokerages will prepare monthly statements just like savings accounts. When you get your savings or checking account, like we do in Life Project, they list the balance of the account and any interest earned. So you should always check your statements, even with investing. You'll get an investing statement, but it won't show you interest because remember, interest is a fixed amount. An investing statement will show you your returns. So you should check your monthly statement from your brokerage or your online trading account to see what fees you were charged. Make sure that there are not any additional fees you were unaware of. Look for strange charges. And hopefully your balance, your savings balance in your investing statement should be rising. You should be hopefully earning money. So to figure out the rate of return on our investments, we use the formula at the bottom of the page. Our annual rate of return is calculated by taking the sales price of the investment, what we could sell it for right now, plus any dividends, that's money that we earned, talked about previously. We add those incomes together, minus what our original purchase price was. So that's the gain. We take that and divide it by the original purchase price. So the gain over purchase price times it by 100 to get our rate. And we have what we earn on that investment for a year. And that will vary from month to month. Every time you buy or sell a stock or shares of mutual fund, you are charged a commission fee by the brokerage. Basically, you are paying the broker to do the trading for you. Now, you can't typically avoid that by using online brokers. There's usually a fee still associated with it, but often is smaller than going through a brokerage. Now, every time there's a fee, that means it's going to eat away at your profit or your returns. So if I have a $5 fee every time I trade stock, and my stock went up $5, and I try to trade it, I'm actually going to break even because I have to pay that $5 fee. So that profit is reduced by the amount of my fees. That's why buying and selling frequently is a bad idea. Day traders have to do a huge volume of stock trading in order to make any profits. It's not a good method for individuals. Individuals should consider investing for the long term. Another type of investment that you can purchase is a money market account. We've talked about stocks, bonds, and mutual funds, and we'll talk about those more and define them. But a money market account is done through banks. Banks are a business. Businesses want to make money. How do they do that? Well, we know that they give out loans and they get interest paid to them for the loans that they give out. We also have these money market accounts. They're a type of savings account, and you can earn higher interest on them. So it is an investment with a guaranteed return. It's just a fancy savings account. The problem is you have to have a very high minimum balance, often at least $10,000. So if you have $10,000 to put into savings and keep it in there, you could do a money market fund and get much higher interest. That allows you to have more access and liquidity. Liquidity means that you can easily access and use the money. Mutual funds are a collection or a pool of stocks, bonds, and other investments that are managed by a professional. So owning a mutual fund is like owning many different companies. You have a little piece of this company, a little piece of that company, and it is diversified. There are a diverse number of companies in there. You might have a stock mutual fund that's all stocks. You might have a bond mutual fund that invests in corporate bonds, or it might be mixed, some stocks, some bonds, any combination thereof. Index mutual funds follow a stock index. The stock indexes are Dow Jones, S&P 500 that we talked about earlier. So those mutual funds are going to follow what the market does. Most individuals invest in mutual funds because they are managed by professionals. You don't have to do the research, and they put a diverse mix together to help balance it out so that when some lose money, other companies are gaining money. Mutual fund companies also charge fees. That's how they make money. So again, you want to look at the fees compared to your growth to see if you are profiting. The fees might be front-end loads or back-end loads. Front-end load fees are paid at the front of the deal when you get it. Back-end load fees are paid when you cash out or sell your mutual fund. Also, many mutual funds often have annual expenses that you have to pay. You pay an annual expenses to cover the costs of the mutual fund manager to do all of the management of the fund. You also want to see if the mutual fund you're thinking about investing in has a 12B1 fee. That's going to pay for advertising the fund. Try to avoid that if possible. It's an additional fee that you get very little for. All of this information would be listed in what's called a prospectus. It's a little booklet describing all of the elements of the fund. If you're going through a broker, they can provide that for you. If you are doing it on your own online, there should be a link to the prospectus. Make sure you pay attention to fees. Expense ratio is basically the amount of money you spend on commissions and fees compared to the average return. So a smaller expense ratio is better. That means you're spending less in fees per dollar. Sometimes you can find true no-load funds, which are funds with no fees. That doesn't mean they're going to perform worse. They're just fewer and far between, so you really have to search them out. So that concludes our intro to investing units. Now it's time to work on your simulation. A lot of this data will also be in the reading part, so pay attention to that. and you will answer the questions for your reading quiz about these topics.